Hi, I'm Lauris Bočs, and you're watching the video commentary to my article, Insurance Industry's Legal Importance to Financial Sector Stability in the European Union. As I already mentioned, I'm Lauris Bočs, and I'm a PhD law student at Riga University. This video commentary is made in relation to my published article in the proceedings of the 5th International Scientific Conference. Let me read that. Transformational Processes in Law, Regional Economics and Economic Policies, Topical, Economic, Political and Legal Issues. Since the topic of my doctorate thesis is about the financial sector of the European Union, its problems and possible solutions, I'm highly interested in providing the research outcomes through as much media channels as possible to reach a broader audience. Hence the participation in the conference with a presentation and submitted article, and also the published article's supplementary materials, such as the recorded audio article and this video commentary. I've gotten into the habit of choosing mottos for all my audio articles as well as video commentaries, and for this video commentary I chose a quote from the Canadian-American economist John Kenneth Galbraith. The imperatives of technology and organization, not the images of the ideology, are what determine the shape of economics. As the published paper is only a couple of pages long due to restrictions, I'm actually inclined to talk briefly here as well, in order to just reflect on the topic within the bounds of the paper. First of all, the Solvency II directive has established an unprecedented ground for EU-wide insurance regulation, as the Solvency I directive was established more than 40 years ago, and many things had to be looked at within a modern context. Secondly, as the directive came into force in 2016, several points in balance sheet capital requirements, as well as inner control and outer supervision rules, have been formally harmonized, but still have yet to show an impact to the overall stability. So debates about them are mostly hypothetical. What can be differentiated is the market share of bigger institutions. Harmonized regulation can mean homogenized approaches to regional markets. So the biggest portfolios are probably more well off to go into several national markets with similar policies. The question I pose is if that should have the effect of allowing better price-performance ratios for the customers, or just bigger domination of markets by the largest insurers. As the competitiveness of the EU's internal market has not been a political priority, I suspect it's the latter, simply because the overall benefit tends to lead to better profit margins within a bigger organizational structure. Nevertheless, by itself, it could also at least mean that policies for customers could become regionally expanded at a reasonable price inflation, at least in the short term. So my takeaway message is fairly simple. The legally integrative process of the insurance markets has many analogies with the banking and investment sector. So either lobbying in the EU has got to be more regulated, or the market tendencies will lead to consolidated conglomerates that tie up massive assets until they reach systemic importance for overall financial stability. It's for time to show whether or not that would lead to the journalistic slogans of too big to fail or too big to jail. Either way, I'm suggesting to look into the legal options of creating harmonized asset value protection programs for at least all obligatory insurance services in a way that uses monetary inflation compensation mechanisms, such as tax credits, for instance, would allow. The legislator has a lot of options when it comes to budgetary and tax policies, so it would be a matter for an educated debate rather than political ideologies. I know this video commentary is too short to give anything more than just a viewpoint, but I hope that this was at least a spark in a constructive direction. With that, I have concluded my video commentary and say goodbye till the next time.